What's up, everybody? Welcome back to my channel. My name is Devin Burr. In this video today, we're going to talk about something that I get all the time. People say infinite banking is only for the rich and the wealthy. I had a comment a few days ago on my YouTube here, and I'm going to read this to you guys. And this video is going to be answering this comment. So the comment says, "This is a great video. Thank you. However, like all their IBC videos out there, you're using numbers that don't fit the majority of people's income and budgets. Let me see an example of a healthy 45-year-old male starting with $400 a month. Be sure to show the early years. They're ugly. Don't leave that out." So guys, I am going to show you infinite banking for someone who is 45 years old and they're not putting a lot of money in. Let's go ahead and jump into it. So infinite banking can be done with a small sum of money. I will make this caveat though, is that the older you are, the more you have to put in because you don't have as long for your money to grow. If you're 20 years old, you don't have to put as much money in because you have a longer runway for that money to grow and use it for infinite banking. If you're 60, you got to put more in than the 20-year-old. So what we've found is the minimum for this to work is your age times 10 per month. So in this example of the guy that's 45, he wouldn't be able to do 400 a month. It wouldn't be enough in there for it to compound and grow and be able to use it for infinite banking. So in this example, we'd want to be at least $450 a month for a 45-year-old male. So that's what I'm going to illustrate to you guys. I'm going to show you the exact numbers on a policy that I ran so you can see that this works. Okay, so infinite banking on a 45-year-old male who is healthy, putting in $450 a month. Let's jump into it. This guy's name is Cash McPolicy. I just ran this illustration. 45 years old, standard, no tobacco. He's putting in $57.59 annually. That's chopped up into monthly premiums. It also includes a term insurance that is necessary to keep this policy non-taxable. And I'll explain why in a minute. But this amount is the annual amount. He's putting in monthly about $480. You can see that there. So that's the whole life insurance of $450 and about $30 a month for term insurance. So putting the money in, check this out. First year, he's put in $57.59. His cash value at the end of the year is almost $4,400. So the first year, the ugly years, he put in an amount of money and he's got access to about 75% of that. That's not bad, guys. Think about a 401k. You put money into it and you've given up control of all of it until you're 59 and a half. This guy's 45, so that'd be 14 years of giving up control of money. With this, he's only giving up control of 25% of his money the first year. The rest of the money, the insurance companies letting him control it. That's what the cash value is. Cash value is the amount of equity that you have within a death benefit. So the death benefit amount on this policy starts at $108,000. The first year he's got access to $4,400 of that $108. So that's the equity within the death benefit he can use for whatever he wants. That's where infinite banking comes in. You're borrowing the insurance company's money at a cost. They charge an interest rate, while your money is compounding and growing inside the policy. So you're just borrowing the insurance company's money at a cost and taking it to make more than that cost. It's the same thing that banks do. Banks get deposits, they pay you an interest rate, and then they lend the money out for more than what they paid you. They kept the difference. Your deposits are their capital. These premiums are your capital within inside your banking system. So I will tell you guys, infinite banking will work with any sum of money. It's just the smaller the sum, the longer it's going to take to really use it for a lot of things with infinite banking. But you can see the first year, you got access to $4,400. That's your capital that you could use to pay off debt, to go buy a really inexpensive car, I guess. There's not much you can do, but you could still practice the concept. You got to just give it time. You have to capitalize your system. So let's go into year two. Year two, you're putting in the same amount, $480 a month, which includes the whole life plus the term rider. Now this year, your cash value grew by $5,100. So you now have $9,500 that you could use in cash value. But check this out. You put in 5,700, it grew by 51. So let's see what that math is, guys, real quick. If you have 5,100 bucks in growth from putting in 5,700, you have access to 89% of what you put in. So again, the first year, you are giving up control a little bit of your money, right? But the second year, you're giving up control of a little less. You have access to 90% of what you just put in that year. Now, year three, you put in 5,700, you got access to 5,400. That's how much the cash value grows between these 2 years. So you've got access to almost all the money you've put in. Year four, 5,700 goes in, you've got access to 5,700. Think about that. 4 years in, this guy's only 49 years old. He's put in money. He's got access to all of it, tax-free. He can use it to pay off debt, use it to go make more money. He doesn't have to pay it back, because if he never pays it back, the death benefit pays off the policy loan. And all of this money he's been putting in is continuing to compound and grow tax-free. So it gets better and better and better the longer you have the policy, because you're getting more money in there to compound and grow. It still works. It just takes time. So let's get a little further into it. You've got, let's see, by year 10, okay? Year 10, this guy's 55 years old. At this point, he can only put in 5618. Reason for that is because the term insurance dropped off at year 7. Year 7, the term insurance dropped off because it's no longer needed. Basically, with these policies, when you're overfunding them, which is what infinite banking is, you're putting in paid up additions. Paid up additions are just extra money on top of the regular whole life. They give you a whole bunch of cash value and a little bit of death benefit. So if you do that and you do it too much, the policy becomes taxable because the death benefit is not high enough to support how much money you're putting in. So the way around that, we just put a term rider on the policy. And once the term rider is no longer needed, we drop it off because it's just extra cost. So you can see for the first 7 years, there was about $65,000 of term insurance on the policy. So year 10, there's no term insurance. It's just the whole life insurance policy, which is base premium plus paid up additions. Now, 5,600 goes in on year 10. The policy's cash value grows by 8,000. So he's put in 5,600, it grows by 8,000. Let's look at what the return on that is. So that means that the net growth is 2,400 bucks for putting in 5,600. So that is a return of 42.8% on that 5,600 bucks. That's only year 10. He just got a 42.8% return on his $5,600. Now he can take all the cash value and go make a bigger return. So do you see, guys, how it just gets better and better? The first year, he gave up access to about 25% of his capital. He put in 5,700, he had access to 43. Year 2, puts in 5,700, it grows by 5,400. So he's given up access to a little bit more of the capital. By year 4, puts in $1, he can use $1. He's not giving up access anymore. He's getting gains. Year 10, a 42.8% gain on the $5,600 that he put in, because he's given his policy time to grow and time to compound and have a foundation. It'll get better and better every single year. So these are the numbers, guys. This is just the policy. Infinite banking is a concept of how to use a policy. So let's bust out the whiteboard, show you guys a real life example of how this guy could use his policy for infinite banking. And that way it'll all come full circle. You guys can see a smaller policy can be used. It just takes a little more time. So we've already seen that a policy can grow. It can have, good liquidity, even with a smaller dollar amount. So let's put the actual policy into practice. Let's put it into the concept of infinite banking. Now, 1 year has gone by. This 45-year-old male has put money into his policy. He's got $4,300 in cash value. So what he's going to do is he's going to take a loan against that cash value. So the insurance company is going to use this money as collateral to give him a loan of his future death benefit. Let him use a portion of the future death benefit while he's alive. So he's going to take that borrowed money, that $4,300, and he's going to pay off, let's say, a personal loan. Okay, he's got a personal loan. Payments are, let's say, $250 a month for 2 years, whatever the terms are. Whatever those terms are, he's going to simply take that money and pay it back to his policy. So this is infinite banking. It is treating your policy just like a bank. Deposits come in. That's your cash value. So premiums are deposits. Just like a bank, deposits are what they can use. It's their capital. Your premiums are your deposits. That's what builds your cash value. As your cash value grows, you can turn them into loans. That's what banks do. They take deposits and they loan them to other people to make a spread. That's what you're doing with infinite banking. You're taking this cash value and you're paying off, let's say, a personal loan with a $250 payment. That personal loan has a high interest rate. So all you're doing is you're now getting that interest rate, that money, back into your policy where it compounds and grows tax-free. So if you do this for an entire year, that $250 is available in your policy. You're just paying down the loan on the $4,300. So over 1 year's time, you've paid yourself back $3,000, right? 2,500 times 12 is $3,000. Now here's the cool part. With this policy, year 2, remember, $5,700 went in premium, in deposits, to grow the cash value by $5,400. So this guy has paid himself back $3,000. That's money he used to give away, money that would leave him and his family forever. By practicing infinite banking, that $3,000 now is back in his control, and it includes interest that he used to give away to a third-party creditor. So now he's got $3,000 plus the increase in his cash value, which for year 2 was, what was it, $5,100, I believe. So altogether, now this guy has, and this is just in year 2, $8,200 of availability that he can take to now go pay off another debt. And now not only is he recapturing the $250 a month that he was paying on the other debt, or on this debt, this personal loan, he's now able to recapture another debt. Let's say it's $300. Now he's keeping $550 that he used to give away every single month, which included interest, and that money is gone forever. Now it's back into his policy where it's protected. It's protected from lawsuits and judgments. Nobody can touch that money. It's his. He's got control of it and him only. It's growing and compounding, guaranteed tax-free. So that means every single year he can use more and more money. Like I said, guys, year 10, he put in $5,600. The policy grows by $8,300. So I think that was the 48% return we talked about earlier. This is infinite banking. You can do it with very small amounts of money. It's just it takes longer. If this guy had 40 grand that he could just plop in, all of a sudden he's got access to 33, 34 grand right away. So now he can really start doing some things. He can pay off a car, he can pay off some credit cards. If you can't put in large sums of money and you can just put it in monthly, It's just going to take you more time. You've got to be patient in order to let the cash value grow enough to use it. That's it. But it's inevitably going to happen. If you put money into a policy and give it enough time, it's going to be really, really good for you. So as you can see, infinite banking can be done with a smaller sum of money. It just simply takes a little longer to start implementing the concept, but it can definitely be done. The more you put into a policy, the better. It's just like a bank. The more deposits they get, the more money they have to lend. With policies, it's the same way. It's a banking system. You want to view premiums as the more you put in, the more access to capital you have now. And you can access that capital tax-free. Your money grows tax-free, never gets interrupted, so it just gets bigger and bigger and bigger. But even if you have a small policy, you can still do the concept. And as you can see with this example, that first year, you recaptured $3,000 that you were giving away before. That personal loan was $250 a month. That's $3,000. That's money you would have lost forever. You got it back now. And your money kept compounding and growing at the same time. Year 2 comes around, you got access to more. So the longer you practice this concept, the more money you inevitably have, because you don't lose it to outside creditors. You keep it. And it's all about how much you keep, not about how much you make. So if you guys are ready to implement this concept for yourself, you can do as little as $100 a month for each year of your age. So if you're 20, you could do $200 a month. That's the bare minimum. If you're 30, $300 a month, 40, $400 a month, so on and so forth. But you want to start thinking about, how much can I get in there? The more I can get into a policy, the better. It's going to grow faster. You're going to be able to use it sooner. So mindset is the biggest thing. It usually needs to shift. But if you go ahead and register for my free training video, it's in the description in this video. You can watch a free training so you can learn exactly how you could use this concept more in your life. And at the end of that video, if you want to schedule a call, do that so me and my team can help you really start using this concept in your life to take back control of your money. So if you guys like this video, I know that you're going to love that one. So check that out, subscribe to my channel, like this video, all the things the algorithm loves. I would appreciate it. Until next time, love you guys. Peace.